Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Last weekend of February, weekly market recap. Yeah, you heard me right. Whether you believe it or not, or you do realize or not, time goes by, it actually goes. So we are already approaching March. Bit of a crazy week if you were following the news, not only for financial markets, but I mean news in general. We are really up for the madness now, with Trump calling Zelensky a clown, Zelensky, of course, answering back. Then we are witnessing the usual division across Europe, and God forbid what's going to come out from the German elections this weekend. It might be disruptive for the EU politics. Um, and just this morning, I was checking the news, and it looks like these Bannon actually came out with CK, kind of like what Trump, not Trump, Elon Musk was accused right after the elections. Is it true? Is it not true? Was it intended? Was it meant? Was it not meant? Time will tell, I guess. But as for what concerns us in financial markets, let's just have a look at the economic calendar. So it was a week full of news, a lot of them not particularly relevant for the US markets, especially, but they were there nonetheless. Starting out with the RBA finally deciding to cut rates, so 25 basis points drop. And if you check, they were actually higher for longer. I mean, Australia really kept rates very, very high. I mean, relatively, but they were the last one to give in on these higher for longer. So, I mean, probably the Australian economy, it's much more, resilient than all the rest, which, to be fair, historically, it didn't really suffer a lot of downturns, or at least, not in in the same magnitude compared to other parts of the world. But I mean, slowly but surely, they're getting there where the rest of the world is going. We are all synchronized in this globalized economy, right? And financial system. What's next? Canadian CPI came in kind of like a little bit of a tick up, same as the US, I guess. Same we could say about the UK. Yeah, GBP CPI year over year came in at 3%, forecasted at 2.8, previous read 2.5. Yeah, an uptick even there. Uh, I don't know how much relevant this might be. The Empire State Manufacturing Index ticking up a little bit. Nothing substantial really, but it was kind of interesting because these data it's confirmed in the Philly Fed Manufacturing Index, which again, all these sentiment grasping surveys, I always take them with a grain of salt, especially because if you check the Philly Fed Manufacturing Index, they are just interviewing, I think, 250 companies or business in the Philadelphia area. So, I mean, we can actually read it. I think, yeah, survey of about 250 manufacturers in Philadelphia Federal Reserve District. So, I mean, how much weight will you put on it? Probably not a lot if you're trying to grasp the overall strength or weakness of the manufacturing sector across the board for the United States, but nonetheless, it's a data which is there. Then, of course, we ended up the week with a bunch of PMI coming out from all across Europe. We're not going to check them. And, of course, from the US, where it was a little bit of a binary type of read. Because, as for the manufacturing, that was actually a good read. I mean, it was forecasted at 51.3, came in at 51.6. And the previous read was 51.2, let's call it. So, I mean, it went up, positive read. But then you check the services, and they came in below expectations and below the previous rate. So a little bit of a dichotomy there, I guess. I tend to believe that the services sector it's much more important for the US economy because of how it is structured. It's a consumer-based economy. So, I mean, although, Trump may try to change this, at the current moment in time, pretty much all the manufacturing, it's made abroad, not domestically in the US. So, I mean, the impact that the manufacturing sector has on the economy, it's subdued to say the least. And then we got Michigan Consumer Sentiment Index revised a bit lower. It came in lower than expected and lower than the previous read. So again, another type of sentiment check, which is a bit disappointing, maybe as for this read alone. Although, if you check the trend starting from 2020, uh, never seen an uptrend again. So, kind of like always the same. Over the long, long, long run, it doesn't look like we are out of the woods yet. But intraday, intra-week, and even intra-month, many different things could happen. So, speaking of which, let's start to check the charts, and let's start out with the DXY in a weekly time frame. Um, Not a lot. I mean, if you just check the weekly candle, it's a tiny, tiny candle relative to all the surrounding ones. So, I mean, not a huge deal. We are still in that kind of a limbo. I mean, do we stop here? Do we retest the previous range high of the macro range? Or do we crack it and we need to feel in this move to the upside a bit more? If you remember last week, we were checking these levels. One right around here, and the other one would be the equilibrium of the macro range. Zooming in, what you can notice is that we started out the week with a little bit of an up move and it was rejected, and especially on Thursday it was completely reversed. So it's an ordered type of a pullback. I've seen people calling for a top in the DXY. So I mean, is it? At the end of it, at this point, yeah, if you're talking about a local top, you most likely have one, which, to be fair, it was confirmed way ahead of this week, right? Um, but if you are talking about macro, I don't know. I mean, are you calling a top in the sense that it's gonna go for a complete U-turn and getting back below 100 or below 98? I don't know about that. We need to assess it week by week. But at the current moment in time, I keep seeing it particularly good. I mean, it's good for the DXY itself. It's basically a shithole for the rest of the world and the rest of national currencies, which are not the US dollar. But anyway, speaking of other currencies, foreign currencies, let's start out with the euro, right? Which tried to put together another move to the upside, but it was kind of, don't want to say crashed because it wasn't a crash. It was just a pullback. I mean, he saw a little bit of a rejection at the same levels of the past month and a half, 2 months, basically. The pound, instead, the British pound, it's showing a little bit more of a strength relative to the euro. So, I guess kudos to the Brits. I I never really figured why would you like the British pound more than the euro, but that's the market talking. So, might be up to me to actually try to figure that out, okay, instead of questioning the market. Um, as for the dollar Canadian, the loonie, nothing special here. I mean, we are still tapping into these levels. Uh, Probably, I mean, if we can crack them, we might get a bit more of upside toward 1.4 and a half, 1.4 even, something like it, maybe. And of course, I mean, always remember the chart is inverted. So if I say a move up, but you see the numbers actually declining, it's just because I inverted the chart to kind of match up the euro and the pound relative to the DXY. Same goes for the yen. I mean, if you read it, it's dollar, Japanese yen, but it's a USD JPY. But if I keep the chart inverted, I just have this one, same as this one, mimicking what the euro or the British pound are doing because they do have the dollar at the denominator. So just to have a little bit of a uniformity. Quick reminder that. Um, Japanese yen keep on climbing to the upside, uh, which I mean, again, I always say to me personally, I guess it's not really about the overall direction, but it's about the rate of change. Okay, I already seen it many different posts on X or former Twitter. I still like Twitter better as a name, but I've seen a lot of posts talking about the yen carry trade blowing up once again. Now, is it? Is it really blowing up? I don't know. I wouldn't say so. I mean, up until the point it moves relatively slow, I wouldn't call it a blow up. Financial actors can actually adjust their balance sheets and their positions and their, leverage and margins and whatnot if the move is low enough to allow them that flexibility and that reaction time. So basically, all the opposite of what you got at the end of July, beginning of August, to put it bluntly. All right. Don't want to spend a lot of time on currencies, if not to reiterate that it looks like this ruble pump we were looking at last week, for now actually showing legs, so keeps on going higher. But even the Chinese yuan, it's starting to consolidate in a way which is starting to look like a little bit of a reaccumulation. We'll see if it can actually break the highs and try to run. And TradingView just died on me, I guess. Oh, he's back. If, beside the ruble, the rest is back. So, all right. So we'll see. As for the yuan, I'm not expecting really huge things, but I guess up until the point of the DXY it's pulling back, that might be good. Um, the rest it's kind of like the same. The Indian rupee, it's kind of like the same pattern we observed in the dollar Canadian. Less sharp of a reclaim, but if it can grind to the upside right here, reclaiming the previous range high of this dealing range, maybe we might see an extended bounce. But for now, not yet, I'd say. But we'll see. It all depends on the DXY at the end of it. I mean, not really on the DXY, on the dollar, right? The DXY, it's just the majority of the index is made up by the euro and the yen. So, you know, let's move on to Bitcoin. Bitcoin gave that illusion. I mean, it was kind of one and the same. It's still the same range play. We started out the week with a little bit of a down move on Tuesday, and then it was completely reversed. And there was a point throughout, especially on Friday, yesterday morning, where it was looking like this is it. We might resolve this consolidation to the upside finally. But no, New York session Friday afternoon, evening, it was just smashed down, as the rest of the market, to be fair, because we're gonna get there when we look at the equities, but not a good day this Friday for markets in general, right? Then again, is it something conclusive or substantial? I mean, I guess it's not. It's really at the same levels. Let's just try to zoom out on a weekly time frame, and you see that although the market is not closed yet, it might just be a little bit of a doji. right? Let's have a look at the futures just to see how the futures closed. Mm, Well, if you look at the futures, they're depicting a little bit more of a green situation. Let's check the daily close. The closed on weakness, but then again, it's a 24/7 market, so I I would be more focused on spot when it comes down to Bitcoin. Not saying the futures they don't play a role, but since I'm seeing it a bit more like a commodity rather than a currency, um, I would look at the spot price. So again, it's boring. Uh, you could just copy paste the same analysis as of last week. I don't really see a lot of stuff going on. Um, if you really want to put a little bit of a bullish spin on it, you might say, well, you know what? After this sharp rejection and price coming down and stalling at the lows right here, that was the time where you would have expected the bears to step in and really dumping price down. Didn't happen yet, so the more price can actually stay stable at these levels, the more it should be good for the bulls. Really, I mean, assuming you are approaching it with a bullish type of perspective. I'm not saying this is what I'm saying. Um, quite honestly, I'm seeing nothing here for now. So no matter how you cut it, I would be particularly neutral up until the point we can't really start to manifest intention to go one side or the other. That's it. Let's check gold. Well, gold closed the week around the highs, so not particularly bad. I was expecting a little bit more of a pullback, to be quite honest. That doesn't mean it can come right after this failure at new highs. We'll see next week. Um, but still, I mean, even if it pulls back toward 2,800, 2,700, I wouldn't be massively concerned yet. The only thing that might concern me when it comes down to gold, it's the correlation in between gold and, let's say, the stock market. If you check the correlation in between gold and, well, let's take the index SPX right now, it's really close to to 1 to 1. And historically, that moment it's not a good one. Basically, for none of the two, not for gold and not for SPX, because when you start thinking about it, what it shows, it's basically that there is no diversification in portfolio managing, in allocation. It's just like everyone is trying to take on risk wherever they can. Might be gold, it might be meme coins, it might be the stock market, it might be corporate debt. Wherever you go, everyone is trying to put on risk to make returns. Which again, we know how it ends, right? While you would expect a little bit of a, I'm not talking about an inverse correlation per se in between gold and stocks, but common belief is that gold is a little bit of an edge against risk, especially because uh, there's always be there will always be a bid for gold, so you keep it as some sort of an insurance policy. Uh, so I, I I wouldn't expect them to be correlated 1 to 1. Although historically that happened, but the problem is what came after that. So that would be the only quote unquote scary thing about gold right now. But other than that, I mean, uh, there are many strange things going around. Like we've seen the Bank of England. apparently not having all the gold they claimed, because they actually moved forward the time required to actually have your gold back if you so desire. I guess first it was like 2 3 weeks. They moved up that deadline to 8 weeks now. So it looks like, yeah, if you ask the gold, it might take a bit more time because we don't actually have it. So we need to either borrow it or straight out buy it from someone else, which is not good for the Bank of England for sure. And then you got this strange thing about, I don't know how it should happen in practice. I guess it's much more complicated than what people may believe. But the US basically revaluing their gold, their holdings of gold, therefore having some fresh 800 billions to put into the TGA, and therefore the debt it's not as bad as anyone might think. It's a lot of talking. I don't know if it's going to come to fruition, especially because I don't think this is something the US government could be on its own. I think that should be some sort of a three parties type of action. Like you would need the collaboration of the Treasury and of the Fed, I would assume. Because you might say by decree gold is reevaluated at a higher price, but then you would need the Treasury to issue new debt against that new gold as collateral, and then you would need the Fed to actually buy that debt and credit the TGA. So I mean, can they do it without all the three parties involved? Or I mean, I don't know. I guess you could just incorporate the Fed into the Treasury. So, and the Fed, and then you got Treasury and government alone, and they are all the same, the two arms of the same body. So they're gonna do whatever the fuck they want. I don't know. I think it was interesting to look at, but I don't really know the mechanics and how it should work, to be fair. So let's move on to oil. Oh, what oil is down. Awful Friday for oil. Still in this range. I mean, so far oil it's really behaving as expected. I mean, to be fair, I don't want to take credit that I don't get to take. I mean, I didn't earn it, but it was pretty easy to forecast that oil most likely would have been in a trading range, simply because that's what happened basically over the last 2 years. Every time you see a sharp move, and then it just mean revert to the other direction and stays in a range for a while. So I mean, it's not really a huge call, but still, fundamentally, there were no reason for oil to be so high. As for the price, there weren't before. Apparently, there aren't now. So just you see oil trading back down to the low side of the range. Uh, it's kind of like Bitcoin on a much smaller scale. It's hard to really pick targets, whether you pick the upside or the downside. But up until the point we are holding this range right here. Uh, Personally speaking, I would favor the downside. And again, not as a sharp drop, but just maybe a slow grinding to the downside, just for fundamental reasons. But that, we've seen, right, 1 month ago, 2 months ago, that just because you might have a fundamental thesis, that doesn't protect you from sudden surges in price as for the asset. So again, it might be one thing having a long-term thesis, then from 1 week to the other, got to be ready for all different type of bullshit the market could throw at you. All right. So now, before checking yields and equities, which I wanted to make them kind of the bulk of the recap for this week, um, let's try to establish a little bit of a premise before getting there as for the charts. All right. So before checking yields or rates, and potentially, the treasuries and the bonds, um, at this point, my view on inflation, disinflation, stagflation, or where rates should go over the medium to long run, it's it's clear enough, right? That there is no need to keep on reiterating that. So just briefly, I guess you could just add on top of it that the rental vacancy index on a national level in the US, it's getting back to levels it was around 2020. I do remember 2020, it wasn't a good period for the economy, right? And at the same time, you look at the wage growth index or tracker that the Atlanta Fed has, well, it's still coming down. So on one side, you got wages or wage growth, even better, which is literally not growing, but actually contracting, right? And you got a lot of rental properties which are vacant. You don't find anyone which is willing to pay the price, the rent that you're asking. I don't know, maybe because they can't afford it. What do you think is going to happen? Well, if you want to find a tenant, you're going to have to lower the price you ask for the apartment, the house, or whatever it may be. Therefore, if rents go down, those are part of the shelter component of the CPI. And at the end of it, they impact 44% on the CPI index. CPI should go down. So that would be one thing. Um, in relation to it, we are still looking at yields which are not really coming down fast, or at least not as fast as how they climb to the upside. But at the current moment in time, it looks like they have topped out a bit, at least in the short term. We don't know. We'll see what happens over the next 3, 6 months. But for now, it looks like they're not really showing willingness to keep on going higher so quick, which in and of itself, it's not a lot. I mean, sometimes it's not unusual to see the market taking a break, right? But it is strange to see yields kind of topping out at a moment where everyone is talking about inflation fears, right? And even if you think about tariffs, I never went over tariffs in my videos because it's too long of a topic, right? But if you really want to touch on them briefly, and you're concerned about inflation or not inflation or disinflation, if you want to try to wrap your head around it, just I guess one of the main point to be focused on is how a tariff works and who does it impact, right? And without a lot of explanations and without a lot of steps by steps, at the end of it, what tariffs impact the most might be corporate profitability, right? Because tariffs, it's in and of itself, is a form of taxation on those companies which are importing goods from the outside and then redistributing them in the domestic market. So those are the first impacted. Then everything comes down to, can they pass those price increases on to the consumers or not? AKA, are consumers able to keep up with inflation or not? If they are, well, it's all good. The government is going to collect more revenues from tariffs. Consumers are going to keep on buying because they can afford it. And companies, most likely, we're gonna see them having higher profits because, of course, in nominal terms, if I keep on selling my stuff at a higher price, I'm gonna increase my revenues, right? And this is evident if you check what happened throughout, basically after World War II, up until recent days. It is true over the short period of time, and even if you smooth out the data, you can see that oftentimes when CPIs, therefore inflation goes up, corporate profitability goes up with that. It is just, there is a logical correlation there. So everything comes down to the ability of companies to pass on those price increases to the consumers. And it's evident enough if you think about it, let's say comparing PPI and CPI. So producers price index and consumers price index. It's clear that when CPI is going up, that is usually a period where producers are able to pass on those price increases to the consumers. Therefore, everyone is kind of happy, especially if, like in 2021 to 22, the government is giving you free money, so you can afford to buy whatever the hell, and companies can ask whatever the hell the price they want because they know you're packed with money that you got for free from the government. So easy peasy, no issue there. The problem is when the steamies are out of the system, the proverbial mouse is out of the python, right? And at that point, you see consumers pulling back, and therefore companies which are seeing the profits going down, uh, and they maybe need to cut jobs in order to maintain those margins. It starts a little bit of a reversion in that growing dynamic, or I mean, growth dynamic would be a much more correct term. So throughout the first Trump term, we've seen tariffs. And if you remember, there was an inflation, no? Corporate profitability went where? Down, right? What happened throughout the end of 2018 up until the middle of 2019, more or less? The stock market went down. So why might be? Well, because again, not only tariffs impact the domestic economy and the domestic dynamics. If all of a sudden it's much less convenient, even for people, even for foreigners, right? It's much more inconvenient for them to sell into your country. You need to consider that roughly 40% of corporate revenues are coming from abroad. So again, you might try to protect your domestic economy, but you are also trying to kill one of the main sources of revenues they got. Which again, what do you think is gonna happen to corporate profitability when this happens? It's gonna go down again. So I don't necessarily think tariffs are inflationary. I actually think over the medium to long run, they bear more risk of being disinflationary. All right. So that would be my take on it, quite honestly. And well, the the real strange thing I'm seeing right now is that throughout all of these, right, tariffs, the labor market, or potentially some geopolitical tensions which could send the price of oil up to infinity. Everyone is worried about inflation, and even if you check the Fed Watch tool, the Fed funds futures, they're pricing in no cuts in March. It's a bit strange because, as I always say, that tool, I think it's a bit buggy. It's more of an index of sentiment in my view, because I've seen it over the last 8-9 months. I've seen it pricing in 7 cuts for 2025, then going down to 0, and now it should be up to 2. Uh, Probably over the next 2-3 months, it's gonna go back down to 0, and maybe then up again to 2-3. Who knows? But still, overall, there is this tendency to believe that the Fed is not going to be able to cut rates because inflation risk is still high. Okay, but if inflation risk is high, why the hell the Fed is talking about slowing, if not stopping outright, QT? I mean, that's what QT is for, right? Together with higher rates, that should tame and break the back of inflation. So if you see inflation risk, why would you want to taper QT? Why would you want to taper the taper of the Fed balance sheet? I mean, I don't get it. Um, because look, they now I'm using the term mask, like they masked it, they tried to mask it as it was all related to the fact that the government won't be able to issue debt because of the potential shutdown, the debt ceiling issue, you're going to run into it. I mean, and that's your response. You just stop QT. If I understood it correctly, I mean, I would agree with those pieces of articles online where they highlight the fact that if the government is not able to issue new debt, there's going to be more liquidity free to go somewhere else into the system because it's not going to be captured and trapped in those treasuries. If you don't issue them, nobody's going to be able to buy them, so no money will flow into them. If they don't flow into them, they're going to flow somewhere else, potentially in the real economy, chasing goods and services higher and higher. Who knows? But I mean, I still don't see why you should stop QT now. And I still agree on the thesis that probably the real reason it's the reverse repo. And I guess the Fed it's starting to be a bit worried about liquidity. Um, so far, liquidity has never been an issue. They started the QT, but at the same time, they got a lot of money in the repo facility. They also lowered the repo rate to incentivize those money to get out of the repo facility. And I guess this was probably November. I don't remember if it was the November meeting, but they did it. Since they started cutting, they did it. And I think again they were starting to push out liquidity out of the facility. So on one side they can taper the balance sheet, but on the other side they are allowing, or better said, pushing liquidity out, and therefore they are not having a liquidity issue. If you don't have a liquidity issue, the market is going to be fine. And in an hyper financialized economy as the US are, you better have the market doing fine because if those falls apart, that's a good chunk of domestic GDP which is just going to evaporate. So again, the debt, the you know the ceiling, the issuance, I think none of that impacts what they are talking about now with QT or stopping QT. I think it's all about liquidity. And although he cannot say it, I think Powell knows it. But it's kind of like, yeah, I mean, I see this problem, but if I go out there yelling to people that we might got this problem, I might be end up being the catalyst which actually generates the problem. It makes it real. Because if I say it, now everyone knows it. I'm just generating the panic I'm trying to avoid. So, I was thinking it's more something like that. Um, that would be my take on it. And ending up this discussion by looking at the opposite of yield, so therefore the bonds. I mean, they started out the week with a little bit of a pullback, but they ended up on a positive close for the week. Uh, so I don't really see something particularly bad for the bonds now. We might have the potential to extend this bounce a bit more all across the curve, I'd say, at this point. So, I mean, I'd be relatively optimistic on bonds. Sure, it might be a choppy mess, but all in all, they should trade to the upside. Now, of course, if you're gonna see something disruptive, maybe it's gonna spike to the upside. Otherwise, it might be just a slow grinding to the upside. Who knows? But I still think we got potential to a bit more of upside before the next, pullback, consolidation, or whatever. So that would be for inflation and rates. All right. Let's try to finish up with stocks in a reasonable amount of time at this point. Interesting week. in the stock or, I mean, equity markets in general. Let's start out with the usual suspects. So the four main indices, right? So not a lot of time spent on the Dow or the Russell because again, uh, pretty much we don't follow them too much, if not the Dow. And I mean the Russell, you know what I think about the Russell, right? So let's focus a bit more on NQ futures and ES. The week started out with a bit of a choppy action, which again, I guess Monday was a bit of a festivity, half day market because of the President Day. So you might roll that out as a normal day of low volume trading, all right? But then, you got Tuesday, Wednesday, price, it's still stalling at these levels. Up until the point you get to Thursday and you see a bit of expansion to the downside. And that's where you need to start thinking. I remember I was particularly on the bullish side last weekend, and I was like, well, I guess it's hard to short these markets because your short might be into profit for a week or two if you're lucky, and then you're going to be wiped out by a massive green candle to the upside, which again, out of the last 2 days of the week, uh, the market really didn't move a lot. The problem now is that all of those risks, if you remember, that we were highlighting throughout the last 2 or 3 months, I mean, sometimes they can come out and bite you. We have talked about the potential risk from a fundamental standpoint, but if you remember last week, we were looking at retailer sentiment. And it was at particularly high levels, and we know what tends to happen when the retailer are particularly exuberant, right? And I guess there is also a factor of positioning into it. Let's say everyone is on the same side of the boat, but what we weren't looking at is margin debt and free cash balance. In a nutshell, what they are, well, of course, I mean, margin debt, it's particularly self-explanatory, right? You are so confident that everything is going to go to the upside that you're willing to take on debt or financing your positions, your speculative positions into the market. What happens is, if you got very tiny margins and price doesn't move a lot for a few days, and then it starts to come back down a bit, you are probably gonna either exit the market voluntarily because you're you are already buying at a level which is not at discount, so to speak. You're buying a market which is particularly expensive, even in the context of this current range over the last 3 months, let's say. And moreover, the market is not going where you were anticipating it to go, and you are paying money on your margin position every day it goes by. So, at a point you might lose your patience and say, you know what, I'm going to give up. Let's see what happens next. Or it could be the broker to actually deleverage your position and close down your position if you don't respect the margin requirements to keep that position open. And that happens, of course, when you see price moving impulsively to the downside in this case. So margin debt were particularly high recently, paired up with consumer and therefore retail investors' confidence. So that could be another telltale sign that something it's getting a little bit fragile in the market structure, right? So not only from a fundamental standpoint, but now we got actual price dynamics, positioning, leverage. I mean, everything comes together and it creates this impulsive move, which it's not necessarily doom and gloom, but still, it was substantial. On top of it, again, you might add that, you know, up until a point, the market was just going to the upside grinding. You could categorize this move, this failure at new highs, as some sort of the buyers just stepped out temporarily from the market all of a sudden, right? And in a day, we gave back a decent amount of profits in terms of days into profits, right? Not talking percentage now. So it's not particularly enticing, and it might there if you say it, there if you don't, but it might have legs. What do I mean? I'm not calling a reversal. I'm just saying we might get stuck in the middle of this range for NQ and the same for ES for a bit of time. Could be a few days, could be till the end of the month. And again, if you remember, we were checking the seasonality for the month of February, which was clearly showing the second half of February historically is a bit weak in the market. So a bit of weakness was to put into the card, I guess. Now, if we check these other layout, it's a bit more evident that, let's take a look at ES, for instance. We tried to break to new highs, we didn't. Then we got all those 2 weeks in between DeepSeek, tariffs, and then there was the CPI. So, the market was particularly choppy, but still maintaining a bullish posture because it was held by these moving averages and they were all sloped to the upside. Now, if you check IQ, it's kind of one of the same. We just didn't have the same high in the middle, but it's kind of like in the same place. What was looking like a reaccumulation, if you do believe and if you do use patterns, right? It was looking like some sort of an ascending triangle. So you would have expected a break to the upside. Why not? What's now? ES kind of broke this trend line again. If you do believe in patterns, trend lines, and whatnot. NQ didn't yet, but I mean, at the end of the day, they should kind of trade in tandem. So if you want to retain a bit of a more short-term bullishness, you could say, well, the Qs they didn't broke the pattern. They actually closed above the 55 daily exponential, so we might reaccumulate at these levels, and we will try again for a push to the upside. And ES conversely will just fake out the breakage of the pattern. It's going to reclaim the diagonal and it's going to pump together with NQ. Yeah, okay, maybe we'll see. I think, if you check, let's say the MACD, assuming you use it, right? You don't have to, but sometimes I check it on these high time frames. There was this divergence. If you check the histogram, which is basically the delta in between these two moving averages, which are components of the MACD, which is again moving averages, conversion, diversion, if I do remember the acronym correctly. When you see the delta creating these discrepancy, whereas you got lower highs on the histogram, but kind of equal highs or higher highs in price action, there is a bearish divergence, which seems like played out in a way. You don't really get the same on the RSI. Like, for instance, you don't have a clear bearish divergence on the Qs. It might be if you look at it in the context of these previous high, but I like to refer to it taking the swings which are, or the dip swings which are particularly close to them. I'm not going too far out, either back in time or well, actually only back in time. You can't go forward. Otherwise you would know the future, which wouldn't be bad for trading, right? I don't like to be too much back into the past because I do think it loses a bit of efficacy, right? Other than that, I mean, you might have it on ES because, yeah, you create a lower high while we make an equal high right here at the same point of resistance, 1, 2, 3. So okay, ES was a bit cleaner. You got, as for momentum, the stochastic, which wasn't crossed to the downside yet. I guess it crossed on a Friday close. So with this dump, the stochastic crossed to the downside. So again, might be another reason why we might struggle temporarily to reaccumulate and go into the upside. So just be cautious right now. A lot of different things coming up all together. Fundamentally, now from a technical standpoint, and although we always say that at the end of it, the debt ceiling problem will be resolved at the 11th hour of the day, still, up until the point it's not, it might be that it's going to play a role as well. So many different things. Also, if you check now, earnings season, it's basically closed. We are expecting for Nvidia on, I guess, Wednesday. Probably going to have another one which was important, I think, on Tuesday. I don't remember what was it. It was another one of these big retailers. Like we got Walmart, and now you're going to have another one, but I just forgot it. uh, no, I got it on the tip of my tongue, but I can't remember it now. If you check the earning calendars, you might see it. It's another one of these big retailers like Home Depot, but maybe it's Home Depot. I don't know. I'm not sure. I don't want to say bullshit. But again, uh, Walmart sent out a bit of an alert for consumers, revising the guidance lower, putting out results which weren't particularly enticing. And we have monitored what happened to Amazon, to Google. So it might be that expectations for earnings were a bit too high. And, differently from the past, this time around, we didn't really smash earnings. So it might be, again, another piece of the puzzle to add to the fundamental table. So, I would just say if I was completely full on bearish before, this week, while we got the kind of the entire picture for the first month, 2 months of the year, and now you got earnings season, which is out, uh, approaching this debt ceiling issue. Many different things could contribute to, tuning down expectations. And again, the majority of the bullish sentiment, it's coming from the retail side of the market, while instead you look at the so-called smart money like Warren Buffett. He's sitting on a massive stockpile of cash, and he's selling a lot of his stocks. Started with Apple. Now we know that he sold a lot of those financial stocks he got. I don't have the chart here at reach, but if you check the sectors, what you're going to see is that financials were hit particularly badly this week. So again, it might be this down move has a bit of legs, or at least it's going to be a little bit more stagnant in the middle of the range. Uh, it's always hard, in my view, to call for full-on reversals. It might happen, it might not. I mean, at a point, it's going to have to happen, right? But I I wouldn't call it yet. Oh, remember that thing we were discussing before, the potential liquidity issues. So, stopping QT, Powell being a bit worried because the reverse repo is drained out. It's kind of the same story as usual. There are many different risks. Sometimes a few of them may unfold. Sometimes it's just the black swan. I tend to believe those which are already there, and you already know, the market therefore already knows, they might bring to a bit of a weakness, but they're not going to be, the proverbial final nail in the coffin, which going to send the market 20, 30, 40% down. So again, let it play out. uh, hang in there till the rest of the month, and we'll see what's going to happen in March. I think next week is going to be a little bit more of the same stuff. A bit choppy, intraday volatility. But I don't think we're going to lose another 10% in a week. At the same time, I don't think we're going to make new highs. So if we are lucky, the market it's going to stay in this range in between the highs and let's say the 100 days moving average. All right, chopping around in this area while a few oscillators might reset themselves and it could regain, reaccumulate, and uh, build back up a bit of momentum to push to the upside. That would be my take on it for now. Don't have anything else in particular to say about the stock market. If not, pay attention to it. And again, as we've said, basically since the end of last year, 2024, 2025 might be the year for traders more than the year for buying and hold investors. So again, probably a bit more of volatility. And with that, guess I don't have anything relevant to say. Assuming all the rest was relevant, which is always up to debate, of course. Gonna leave you off, wishing you a good weekend, good Sunday, good start of the week. Pay attention, be nimble, and as usual, be nice and be cool. Nils out.
Let me tell you something, Mr. Sullivan. Do you care to know why I'm in this chair with you all? I mean, why I earn the big bucks?
Yes.
I'm here for one reason and one reason alone. I'm here to guess what the music might do a week, a month, a year from now. That's it. Nothing more. And standing here tonight, I'm afraid that I don't hear a thing. Just silence.